Form 1120 is the form used to summarize a corporation's income and expenses or losses.
Unlike the partnership return, Form 1065, it has similar parts but runs to 6 pages.
To help in our understanding of these corporate tax concepts and reporting corporate taxes, I will compare some of the rules of corporate taxation to the rules for individual taxation, particularly with regard to Schedule C, which is self-employment income and expenses. These differences are well described in the workbook, so I would encourage you to spend some time there to thoroughly understand corporate tax rules. A corporation's gross income is determined much the same way as it is for sole proprietorships and partnerships. It includes, among other things, revenues from sales or services, dividends, interests, rents, royalties, gains and losses from sale of business property, etc. To understand how to complete Form 1120, I want to summarize some of the schedules which provide supporting information, such as reporting income and expenses. Line-by-line instructions are provided in your workbook. Once corporate income is calculated from all sources, the cost of goods sold needs to be determined on Form 1125A if sales of inventory is part of the gross income figure. As we discussed with sole proprietors and partnerships, inventory valuation requires special emphasis. Even in a corporation, inventory reporting may or may not be required. Sole proprietors and partnerships have exceptions to maintaining inventory, and so too do certain small corporations. If average gross receipts are less than $1 million in the previous tax year, then the corporation is exempt from maintaining inventories and accounting for indirect costs. A qualifying corporation that elects not to maintain inventory must treat goods purchased or produced for sale as materials and supplies. The biggest benefit is that other costs are not added to cost of goods sold. Another benefit is that the corporation is permitted to use the cash method of accounting. Since the majority of your corporate clients will be small, most of the corporate returns you prepare will be exempt from these rules. Let's discuss what happens when inventory does need to be accounted for. By way of review, inventory includes all finished or partially finished goods that are available for sale. Raw materials and supplies are included in inventory if they are acquired for sale or will physically become part of the merchandise intended for sale. The value of the inventory must be determined at the beginning and end of the tax year in order to determine the cost of goods sold. There are 3 common methods of valuing inventory items, and they include specific identification, first in, first out, called FIFO, or last in, first out, called LIFO. We've discussed these inventory valuation methods in previous sessions, so I won't go into much detail here. The inventories can also be valued at either cost or the lower of cost or market value. Corporations using FIFO can use either method, and those corporations using LIFO must value the inventory at cost with some special rules. It's been my experience that the vast majority of corporations use the FIFO method for calculating the inventory at cost. Once cost of goods sold is determined, it is subtracted from net revenue to determine gross profit. All adjustments to income and reasonable expenses for running the business can be deducted from the gross profit. We've discussed this process before. The end result is taxable income. In general, the rules for deducting expenses are the same for corporations as they are for all other business entities. Expenses must be reasonable and in line with the nature of the corporation's business. Once expenses are calculated, they are subtracted from the gross profit to determine the corporation's income, or possibly net loss. Of course, most business owners are always hoping for a net income number, which means the corporation is profitable. But it also means the corporation will be taxed. For proprietorships and partnerships, the income is passed through to the owners. However, in the case of a C corporation, the entity is taxed using a corporate tax rate. A corporation's taxable income is simply calculated as gross income minus allowable deductions and losses. Corporations are not concerned with itemized or standard deductions and exemptions. Okay. Once the net income number is calculated, then federal income tax can be determined for the remaining corporate profit. What is left is referred to as retained earnings, or the money left over from all operations that can be used for further investment or for distribution to shareholders. There are two types of retained earnings: appropriated retained earnings and unappropriated retained earnings. Appropriated retained earnings are not available for distribution. The Board of Directors may declare they be used for expansion of operations or other contingencies. When the appropriation is no longer needed, then it is reversed. The tax preparer should attach a schedule to the tax return that describes the appropriation details. It's very rare to see appropriated retained earnings in a small corporation. Unappropriated retained earnings can be distributed as dividends to shareholders. Dividends distributed to shareholders are fully taxable to the recipient and not deductible by the corporation. Therefore, dividends are essentially taxed twice, once at the corporate level and again at the shareholder level. To make matters worse, corporations could also be taxed on dividends they receive, with the potential of dividends being taxed 3 times if it were not for the dividends received deduction. This deduction is calculated on Schedule C of Form 1120 and then deducted on page 1 of the Form 1120 under Special Deductions. As discussed in previous sessions on partnerships and limited liability companies, there are several pertinent tax schedules that need to be completed to provide backup information Form 1120. In fact, many of the schedules look very similar to the ones used in the other types of returns. The workbook contains detailed descriptions of these schedules. In this session, my intent is to summarize the critical schedules, and then you can study them in more detail in the workbook. As mentioned, Schedule C helps eliminate triple taxation. First, the deduction amount depends upon the percentage of ownership the receiving corporation holds in the distributing corporation. And second, the deduction is limited to a percentage of the corporation's taxable income. Schedule C assists the corporation in reporting taxable dividends and helps you correctly apply the many rules for the dividends received deduction for your clients. The IRS requires Form 1125E, Compensation of Officers, to be filed each year. This schedule ensures that officer compensation meets certain tests of reasonableness, that it is for services actually performed, and that the related expenses are ordinary and necessary. Schedule J is for calculating the corporation's income tax. Generally, small corporations will only insert the line for income tax of this schedule, and they are usually exempt from alternative minimum tax. Larger and more sophisticated corporations may be subject to the various types of taxes listed on Schedule J. These corporations may also be subject to the alternative minimum tax. As with individual returns, the corporation must pay the highest calculated tax between regular tax and alternative minimum tax. The IRS uses Schedule K to ensure compliance in many different areas of corporate tax law. The first couple questions on Schedule K are common issues for small corporations, while others, for larger and more complex corporations, may never apply to your clients. Nevertheless, every question must be answered. Schedule L is a statement of the corporation's financial position or balance sheet. The IRS requires Schedule L to be completed unless an exception applies, and the figures must agree with the corporation's books and records. If the corporation has gross receipts of less than $250,000 and assets less than $250,000, they are not required to complete Schedule L, M1, and M2. Because Schedule L, which is the balance sheet, includes retained earnings based on book income, and the tax return is based on taxable income, differences sometimes may occur. Income included and expenses deducted for the books may not be the same as the income included and expenses deducted for the tax return. The most common example of these differences is the 50% meal deduction. The purpose of Schedule M1 is to reconcile the corporation's set of books with the corporation's tax return. You can think of it as an income reconciliation worksheet. Schedule M1 begins with the book income and ends with tax return income. The differences are reconciled on this schedule. The reconciliation process benefits the corporation as much as it meets IRS requirements. It ensures that certain timing and permanent differences between the corporation's books and the tax return are accounted for. Schedule M2 accounts for the changes in unappropriated retained earnings from the beginning of the year and the end of the year. This schedule is another reconciliation worksheet that demonstrates to the IRS how unappropriated retained earnings are used and that they are not being used to avoid taxation as dividends. Although it may not be required for some of the clients for which you prepare taxes, I feel it's a good practice to complete these schedules whether or not you include them with the return. These three schedules help ensure that you are accurately accounting for changes in the retained earnings and differences between the book and tax net income. One last item needs to be discussed while we're in the Tax Form 1120. The corporation is a taxable entity, and as such, it is also subject to estimated tax payments. Failure to pay taxes when they are due may result in an underpayment penalty. This is exactly the same rule that applies to individuals who do not have withholding taken out of their paychecks. A corporation must make estimated payments unless it can reasonably expect that its tax liability is $500 or less. Corporate estimated payments are calculated on Form 1120W, Estimated Tax for Corporations. The required annual payment, including expected alternative minimum tax, is the lesser of 100% of the corporation's final tax or 100% of the preceding year's tax liability, as long as the tax year was not less than 12 months and that year showed a tax liability. Again, the fail-safe rule is to pay 100% of the previous year's tax liability. Then you should be safe from a penalty if the payments are made timely. The annual payment can be made in 4 equal installments due on or before the 15th day of the 4th month, the 6th month, the 9th month, and the 12th month. In summary, corporate tax returns can seem complicated and confusing, but they don't need to be. The workbook provides some excellent explanations and examples of how to fill out each of the forms and calculate the needed information. These corporate returns may become a bread and butter service for your tax preparation business. And as you work with these corporate clients, you will become more expert in these corporate tax issues and quicker at completing the forms.